US stocks have received another boost as Federal Reserve Chairperson Jerome Powell has announced borrowing costs will likely remain near zero for years to come, while policymakers shift their focus from limiting inflation to boosting jobs.
This change reflects our appreciation for the benefits of a strong labour market, particularly for many in low and moderate income communities. This change may appear subtle, but it reflects our view that a robust job market can be sustained without causing an outbreak of inflation.
But Powell's also warned that the central bank's efforts won't be enough to revive the US economy, which is facing a multitude of challenges. Hurricane Laura has displaced more than 500,000 people and is expected to cause damages worth at least $18 billion. It's also disrupting fuel supplies. Wildfires raging in California have destroyed homes, farms, and other property worth billions of dollars. And officials say these disasters are only making it harder to contain the spread of the coronavirus. The US has the most COVID-19 infections in the world, with more than 5.8 million cases and 180,000 deaths. The outbreak shows little signs of slowing, with the death toll rising to its highest level in a week on Wednesday. The economy contracted by almost 32% in the second quarter, and another million people filed for unemployment benefits last week, while 14.5 million Americans remained out of work.
Given that the US-sponsored, US government-backed unemployment paychecks of $600 a week have actually stopped for nearly 3 weeks now. So on the back of that, we could see an increase in that 1 million figure in the weeks ahead.
Vying for re-election, President Donald Trump says his policies are helping to boost the economy.
Before the China virus invaded our shores, we built the greatest economy in history. Nothing even close. We added 7 million jobs nationwide, including 209,000 new jobs in Pennsylvania. By the way, in the last 3 months, we right, Bernie? Over 9 million jobs, an all-time record. This is now during and hopefully closing moments of the pandemic.
While Wall Street seems to share his optimism, the pandemic, natural disasters, and a sluggish economy are presenting a far more sobering reality for Main Street. Mobin Nasir, TRT World.
Well, for more on this, Mickey Levy joins us now from New York. He's Chief Economist for US and Asia at Berenberg Capital Markets. Welcome back to the program, Mickey. Now, let's start with the US Fed, because Jerome Powell announced quite a big shift in monetary policy for the Fed. It's upending more than 3 decades of a policy where it preemptively raised interest rates in order to fend off higher inflation. Now it's saying it's happy with higher inflation and could effectively leave interest rates at historic lows for years. Is this what needs to be done right now, given the pandemic?
Well, I think you summarized it very well. It's not a subtle change. It's a significant change where the Fed actually favors inflation going above 2%, and that the Fed, as you pointed out, will not move preemptively if it anticipates inflation going up. And this is all part of an effort to support particularly stronger labor markets and the economic recovery. But it is pretty significant. Now, let me bring out a key issue. The Fed would like inflation to go up. It would like the economy to overheat. But it's one thing saying that that's what they want. It's highly uncertain whether all this stimulus will actually work. It hasn't worked in recent years. But nevertheless, it's very positive for stocks because all of this trillions of dollars of liquidity that the Fed has pumped in the system is just pumping up asset prices and the stock market. And we hope eventually it'll be put to work in the economy and stimulate the economy.
Yes, can I ask you more about that? Because as you say, we've got trillions of dollars of cheap money flooding the US and other markets around the world. Wall Street, as a result, has gone from strength to strength. S&P, NASDAQ hitting record highs almost every day, it seems. But is the money just benefiting those who have stocks, or is it flowing onto Main Street?
Well, my honest but unfortunate answer is it's primarily helping Wall Street now and increasing income inequality. And the point is, as your show has emphasized, all of the decline in GDP, and it was almost 32% in the second quarter, but on an annualized basis, it was only down 8% and is bouncing back. That's 100% due to the COVID-19 and now this second wave of the pandemic. It has nothing to do with monetary policy. And a lot of the problems facing the services industry and the shortfall in jobs there has nothing to do with monetary policy. It's all about health concerns and ongoing government shutdowns. And so the critical question is, when will the COVID-19 pandemic start to ease so that people can get back to their normal lives? When that happens, the economy is clearly going to bounce back. Product demand will go up, people will go back to restaurants, and that will lead businesses to rehire. The Fed, however much it wants to help here, there's more than enough liquidity in markets. Adding more by purchasing more treasuries, by keeping rates at zero, it doesn't really help that much more. It really doesn't.
Can I bring up the latest jobless figures now? So last week we heard that another 1 million Americans filed for unemployment benefits, and this trend has been slowly declining, but it's still stubbornly high. Meanwhile, we've got people like Amazon founder Jeff Bezos, whose net worth has now exceeded the $200 billion mark. Other billionaires are adding billions more to their net worth. Why is it then that we've got so many Americans, millions upon millions of Americans who are without work and suffering, yet the top end of town is only getting richer?
Well, there are two different issues, really, and the reason why millions of people are still out of work in the United States is precisely because the pandemic is keeping people from conducting their normal activities, from going to restaurants, from going to amusement parks and public spaces. And so with lack of revenues, those businesses just aren't hiring. I would note that the number of people furloughed in Europe is even higher than in the U.S., but they just don't count them as unemployed. In the U.S., when people are furloughed, they're counted as unemployed. In Europe, the number's over 40 million. In the U.S., it's much lower than that, but we call it unemployment. And once again, there's no question, but the spreading of this pandemic in many states, even though it's come down in New York, has stalled the progress. And once that pandemic runs its course, then people will regain confidence and get back to normal. But once again, this is a health issue. It's not a monetary policy issue. And so we just have to live with it, and the government will provide more support.
Okay, Mickey Levy from Berenberg Capital Markets in New York, thank you as always for your analysis.